Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today we're diving into First Eagle Private Credit Fund's latest filing, a peek behind the curtain of this business development company, or BDC. Don't worry, we will explain what that means exactly in a bit. This filing reveals some interesting shifts, so let's decode what's happening with their investments and finances. It will be a wild ride as always. First Eagle Private Credit Fund just filed this update with the SEC this week, the end of April. This document tells us what's been going on with the company. We will make sure it is interesting for everyone. First Eagle Private Credit Fund is looking to offer a whopping $5 billion in shares. This is a continuous offering, meaning they're not selling all the shares at once but over time, which is more or less like gradually opening the floodgates for investment. Let's break down what First Eagle Private Credit Fund actually is. That wall of text contains a lot of information, so let's simplify. First, it's a closed-end fund, meaning they issue a fixed number of shares, unlike mutual funds. It's a management investment company, which means they actively manage a portfolio of investments. Importantly, they've chosen to be regulated as a business development company, or BDC. What's a BDC? Well, it's a special type of investment company created by Congress to encourage investment in small and medium-sized businesses. This is their purpose. BDCs get some tax advantages, but also have rules about where they invest. They are essentially the middleman between investors and private companies. The fund's goal is to make money for its investors in two ways, primarily by collecting income on its investments and then, to a smaller degree, by seeing their investments grow in value over time. A company that wants to grow at all costs probably will not care about such things, but this report states that they are being risk adverse. The key here is where they're putting most of their money. They focus on private credit, or loans to private companies in the United States. These aren't your everyday Fortune 500 giants. These are smaller, often family-owned businesses. First Eagle Investment Management, or HEM, runs the show. They're the advisor, guiding the fund's investment strategy. FIM is a big player with $144 billion under management. The sub-advisor FIAC does much of the alternative credit investments with their $7.1 billion of assets under management. There's a major shift coming. Genstar Capital is buying a majority stake in First Eagle Holdings, the parent company of FEIM. This means the ownership structure is about to change big time. It is expected to be completed in the later half of the year pending approvals. This changes could affect fund direction since it could change investment objective or policies. Let's talk about fees because those can eat into your returns. While the fund itself doesn't charge an upfront sales load, watch out if you buy Class S or Class D shares through certain brokers. They might tack on their own fees, which can be around 3.5% of NAV for Class S. Class I shares do not have those fees charged by brokers. The annual expenses is where it gets interesting. For Class I shares, which are typically for larger investors, the total expenses are about 10.71%. Class S is up to 11.57%. These percentages really add up over time. This also does not include the maximum early repurchase deduction of 2%, something important to note for investors wanting to pull out money early. These are important numbers for potential investors, assuming a constant 5% annual return. This could be higher or lower in reality. After 1 year, dollars becomes $879 an investment, 139 is lost to fees. If it becomes a capital gain, it gets worse, with the investment becoming $81 fees of $11.19. These reports require a risk section where we need to consider. The fund has only been around for a short while, so there's not a lot of history to judge how well they perform. This can make it difficult to predict the future. Many of the fund's investments are not publicly traded, so they will be valued at fair value estimated by FEIM. This can be subjective and might not reflect the actual price if they were sold today. Important to note is that you should not expect to be able to sell your common shares. This is not a liquid asset. The advisor FIM might get paid incentive fees even if the fund loses money overall. This sounds weird because this means they can get rewarded even with bad performances. Finally, there is also a chance that First Eagle may default under their credit facilities, which are lines of credit they use for investing. This is never good and is risky. First Eagle notes a few capabilities that its management offers, such as resilience, high conviction thresholds awareness, and most importantly, its focus on downside protection. This is important to highlight since they are making investments with high risks, as we discussed before. First Eagle plans on continually selling new shares. This keeps the fund growing, but also means existing investors get diluted, meaning their ownership percentage decreases. It also means First Eagle will need to continue to find enough investment opportunities to use the new capital. NA, or net asset value. This is how they say how much your shares are worth. NAV is calculated each month, but it's important to note subscriptions are made 5 business days prior to the end of the month. This means you won't know what the actual price you're paying when you buy in. There are significant rules on how they pay fees to Fineray members to make sure those members are not improperly induced to offer investors something because it benefits them personally. To control expenses, the advisor has agreed to pick up all of the tab on expenses for now. This is great to see, but remember that they will later get reimbursed, decreasing profits. Like most companies, First Eagle acknowledges it has conflicts of interest with its advisors and affiliates. They say how they solve it using the co-investment order, which lets them co-invest with other First Eagle funds, but they may not always be able to take advantage of the same opportunities. There is a chance First Eagle will have trouble putting all the money they raise to work and may be forced to put money in low return accounts or liquid assets. It could be a big drag on overall fund performance and a big risk factor to look out for. We get to see more fees listed here, such as shareholder servicing and distribution fees and expenses paid to the administrator, in addition to incentive and advisory. Be sure to check how much of your return goes to the advisor as opposed to you. In fairness, they mention the importance of good valuation, but the risk of a subjective pricing being used remains, especially in a difficult market. The prospectus states actual expenses may be greater or less than shown. Make sure to look carefully at what is presented. It's important to keep in mind how small their operating history is. With such little history, it's hard to be sure that anything said about results applies to anything going forward. The fees are looking better in hindsight because they grew so quickly. Keep in mind that past performance is no guarantee of future results. All of this is a bit technical, so we will try to recap. To simplify, this filing updates key financials and details for First Eagle Private Credit Fund's continuous offering. They are trying to raise $5 billion to invest in private credit markets, mainly loans to smaller companies. So what's the verdict on First Eagle Private Credit Fund? The chance of higher income is great, but there are plenty of risks involved. Management is also incentivized to keep expanding the fund by finding new investors, which means your own investment gets diluted. In summary, it's not the best financial product for risk-adverse investors. @Luch, thanks for watching. If you enjoyed this video, be sure to like, subscribe and hit the bell icon for more corporate deep dives. Also leave any questions below and I'll get to them.